Hey everyone, in this video we're going to walk through the study guide for the final exam. And to begin, I just wanted to highlight that there is an initial tab here that says study guide, and this is just a breakdown of about 21 topics that you should hone in on when you're doing your studying in order to be able to answer the multiple choice questions. Some of these are cumulative, some basics about knowing account types and things like assets, liabilities, revenues, expenses, accounts payables, receivables, all of the foundational stuff that hopefully you're going to walk away from the class with. There is some stuff that's related to more current chapters in terms of cash flows, etc., treasury stock, so on and so forth. So make sure that you read through this and you spend some time studying up on these topics. Like I said, that's going to help you, answer questions for the multiple choice section. So, okay, with that said, let's get into the actual solving of some of these work problems here. So in addition to knowing all the concepts there, it will be helpful for you all to understand how to solve these work problems, or really essential that you understand how to do these. I'm going to just take a little snip screenshot, bring this over so I can have this next to our template here as I go through and solve the problem. Okay, so here we've got a template to do the work in, and let's go through and figure out what our actual cash flow from our operations was here. So starting out, cash flows from, remember we have three different categories. There's operating activities, investing, financing. So remember, anything that goes in financing is going to be anything related to paying or incurring debt, or anything related to equity like stock issuances or dividends. Investing, we're going to have any activities that are related to actual just straightforward investing into things like long-term assets, but also purchases or disposals of machinery or equipment or other depreciable assets. And then everything else kind of falls into the operating bucket, essentially. This is all the things from normal operations. And we're using the indirect method here. So the first thing we want to do is put our net income in, and that's on basically an accrual basis. So we need to go back through and kind of adjust for things that are inside of net income but are not a cash transaction, because that's what we want to get down to, is really like cash basis, net cash provided by operating activities. So okay, so the first thing we want to look at then as we're going through is to analyze the income statement and also look at the detail here for what it tells us in regard to changes in the operating assets and liabilities. So, and just to highlight, there's this section here is specifically for those types of changes, and like AR went up or prepaids went down, AP changed, so on and so forth. So then up here we've got a breakout for inputting non-cash types of things like depreciation, amortization, so on and so forth. Okay, so with all that said, let's get started. So in this problem here, we can see we don't have depreciation necessarily, but we have amortization. And remember, the whole thing about amortization is basically it's reducing an asset over its life, similar to depreciation, but not long-term lived asset necessarily. So, but if we have a prepaid rent expense, and I just wanted to kind of walk you through the logic here, so maybe this will help. Remember that when we first buy here, let me do the journal entries. I think that's probably the best way to show you. When we first pay a year's worth of rent, for example, we're going to credit cash and we're going to debit prepaid. I'm just going to say prepaid rent. That'll be our initial journal entry. And so let me do it. A little debit credit here. So think about, at this point, let's say it was $100 a month, or let's see, 1,000, just to make it a little more realistic. Whoops. And then this journal entry that we record at the outset of the initial payment of the rent contract for a year, is going to be a cash outflow. But remember, that is not going to show up on our net income because we haven't yet amortized any of this rent yet to recognize the expense. And how that happens, if you recall, our whole accounting around prepaid rent is that, say 1 month has passed, then we end up recognizing 1/12, if this was 12 months worth, of rent expense, and this does go to the income statement. So when we start our operating section looking at net income, it has this $1,000, for example, whatever it would be for this, has rent expense or amortization expense in this instance of $77, or sorry, not 77, it has 88 in this example, but that's kind of comparable to what you would see, something like this, where the expense happens after the cash flow, and the cash flow all happens at once up front. And this is accrual accounting, which is what we want to do. But for the statement of cash flows, we have to kind of change back to this. So that's why we take net income. Say it was, I'm just making numbers up here, but say net income for the period was 15,000. And let's do that. Let me do this actually. Let's just say it was real simple. So let's just say we had revenue of 20,000 for this one period. For example, let's just say we had rent expense. That was our only expense of 1,000. And so our net income then becomes 19,000. But remember that in this instance, what we want to capture in the cash flow statement is the cash outflow. So this doesn't, if we start with net income, we only capture $1,000 of that 12,000 because only 1 month has passed and we're using accrual accounting. So that's why we have to first add back the rent expense. So we add this number back basically to get, because it's a non-cash expense in this instance, and here really it's amortization expense here. But then how we adjust for this is essentially by taking the difference in, so we say if prepaid rent went up by 12,000 basically, and really the way that this works in this instance with prepaid rent typically would be that, and let me just show you real quick. So we'd say change in prepaid rent, and then that becomes, you see a $12,000 change, and that's where you would back out the 12,000 because that required us to pay that much cash. And so then if we do it this way and say net cash flow from operations, I'll just say net cash flow, then that becomes, add all those up and you have 8,000 because we had 20,000 of revenue. We had rent expense that brought us to a net income number. But if that was not the cash impact, that's just the amortization piece, the little bit of it. What happened from a cash flow perspective was we had 20,000 of income, but we paid out 12,000 in cash. And that's the change in prepaid rent, the change in other assets too. So we would have to account for AR and all the rest of it. But hopefully that kind of helps. I just wanted to walk through some of the logic on these and kind of explain it there. But with all that said, let's dive in. So amortization expense, always look for depreciation and amortization expense. And we're going to add that back in like we just looked at. So we're going to add $88 in. Then we have loss on the sale of the building. Again, that was a reduction to get us to our net income number of 77, but it was a non-cash, the non-cash part of that, sale of the building, which will account for the rest of the sale of the building down here in the investing section. So again, we want to add that back because it was an expense that is non-cash. So we want to add that to change net income to a cash flow basis. And then we go through and say AP increase. And when AP goes up, I think it's easier to use your logic to think when AP goes down, that's because we're paying it down with cash. So cash goes down, AP goes down. And you can basically flip that on its head and say, okay, well, if that makes sense to me, then if AP goes up, then cash is going to go up. Or at least, we need to increase net income to reflect net cash provided by operating activities, basically, is the right way to say that. Again, sometimes just thinking of the opposite, whatever makes more sense, it's a little, I find that easier to use my logic that way. So again, AR and AP are both pretty easy to use that logic. I think when you think about AP going down or AR decreasing as well, because when AR decreases, what that's reflective of is the receipt of cash after you've already earned revenue, at a later point, because the AR going down means that we got our money. And so when we think about what that's gonna drive is that if AR is going down, cash is coming in from our customers, then it's gonna be a positive, and we're gonna add that back in, right? And there also another way to say that is if AR went down, if AR went up, then we would have that be a negative amount essentially. Okay, so then we've also got accounts. What have we got? Accounts receivable, prepaid expenses. So prepaid expense increase. Again, when prepaids goes up, like we kind of just looked at, that's a credit to cash, debit to prepaids. And so it's going to have a negative cash flow impact. So we're going to say minus 275. And then finally, we had a decrease, I think it says, in taxes payable. And so remember, if a payable is going down, then that means that we're using cash to pay it down, kind of the opposite of what was up here, and the more logical thing to my mind, at least when I think about payables. So payables going down means cash is being used to pay them down, and so that then is a negative in terms of cash flow there as well. So then we just add all those together. We get $55 of cash provided by operating activities. And now we need to look down at our investing section. So we can say land purchased. Remember, anything long-term assets or investments, which are typically long-term assets, but let's see here. Okay, so we purchased land, and these ones are a little more straightforward when we're down in these sections, right? Because we just look and see, land purchase $550. That's the cash piece of it. Proceeds from sale of building, that's the $1,650. And then if we sum those both up, we get $1,100. Okay, then cash flow from financing. Again, we're going to look at anything that's equity related or borrowing or repaying money. And so we had a bonds payable decrease, so that's going to fall in this category. That's borrowing or repaying. And remember, when our payables are going down, we're paying them down with cash, whether it's bonds payable or AP or taxes payable. So that's going to be a negative cash flow impact. And what was the total? $770. And then dividends paid. I think that one's pretty easy. It's being paid in cash. So that's pretty clear, minus impact there. And then we'll say stock issued. And stock issued is cash coming in. Just think of the journal entry. We have credit to stock and then debit to cash. That's selling stock, basically selling the ownership into your business. And so the net cash used by financing activities, and mostly driven by the bonds payable, means that we paid out $550 in net. And then we add all the categories together to get net cash flow. Our beginning cash balance, it tells us, was $220. And then we just add those together. So our total cash flow there was $825. You can see that agrees to, where is it? Not beginning cash balance. I think it says it on here. Yeah, ending cash balance. So that's on our balance sheet. The cash account would show $825, and that's what we have arrived at through calculations. So that means that we have adequately assessed and arrived at the right answer. It's a little check figure there. Okay, awesome. Let's work on the second problem here. So I'm just going to scroll. Actually, no, I'm going to just hide this so it's a little less cluttered. And then I'm also going to crop this picture so that we're just looking at number 2. Let me get rid of this stuff too. Clean it up. Okay, so now we're looking at preparing a cash flow statement using this data here. Same process, it just doesn't have our whole broken out financial statement for us to look at. So again, start with putting net income in. This area is going to be for our assets and liabilities changes. Up here, we're going to look through, and right off the bat, we see depreciation expense. And so we know that's an add back to get to cash flow because it's a non-cash reduction at the outset. And then we have a loss on sale of truck. So same thing, we're going to add that back. If we had a gain on the sale of truck, we would need to reduce that from net income. But with losses and expenses that are non-cash, we add them back in. Then we're going to go down the line here on all of our operating assets and liabilities. So we'll say AP decrease, I'm just going to put these in, AR decrease. Don't want bonds payable is going to go down with financing, right? Supplies decrease, and then taxes payable decrease. Okay. So now, again, liabilities went down. I think it's pretty easy to think through the whole logistics from an accounting perspective. That when liabilities decrease, that's because we are paying them down with cash. And so that's going to have a negative cash flow impact. So negative 240. AR decreased. And so remember that is, if AR is going down, that means the cash is coming in. Right, so that makes sense there. Supplies decreasing. I think that this one can be a little tricky from a conceptual perspective. So if you think about supplies increasing, that would be cash flow going out, so negative. And then this is the opposite, supplies decreasing. So it's going to be a positive impact, basically. And it said 120 was the difference there. So again, sometimes just thinking about it in a different way and then doing the opposite is maybe the most logical from a conceptual perspective. So again, if it said supplies increased, we could pretty easily deduce and think through that logistics of supplies increased because I paid cash to buy those supplies, and if cash is being paid, this would go down. And then we could just flip our thinking since supplies decreased and have this be a positive. And the reason why it's a positive directly related to the supplies decreasing is because there's some expense that is included in net income that's related to supplies going down instead of cash. And so really it's a non-cash expense that we're accounting for here. But sometimes, like I said, if you can think of it where, to my mind, like supplies increase means cash is being paid for those supplies, and that would be a reduction because it's being paid. So then if it's supplies decreasing, alternatively, it would be positive. That's one way to think about it. Again, taxes, if payables are decreasing, pretty easy to think that through and say that's going to be subtractive. Okay, so again, we just add all those together. We get 1560 net cash provided. Then we go cash flow from investing, and let's see, we have long-term assets or investments. We have proceeds from sale of truck of 480. And land purchased of 600. So when you purchase something, cash outflow negative kind of makes sense, hopefully. Okay, then we have bonds payable increase, dividends paid, for anything equity or debt repayment or taking out new debt. Treasury stock purchased. That's going to be an equity type transaction. So if bonds payable, again, most logically, at least to me, bonds payable going down would be us paying cash for that. But what we're saying here, and again, if you understand how bonds work too, this is pretty direct because when you issue bonds, we do debit, cash. It's a direct increase to cash. So hopefully that doesn't need too much, logical manipulation in your mind to get the concept there, but sometimes still those tricks do apply. Dividends paid, this is pretty obvious, negative cash outflow, and then treasury stock purchase, hopefully that's relatively basic as well, that it's a cash outflow for that purchase to get us to 300. So then we just add all three of these together, 1740. Our beginning cash balance was 1200, it tells us here, and so that would mean just by adding these together we get 2940, and lo and behold, here's our check figure. Everything ties out, and we're looking good. Cool. Okay. Unhide here. I think that's everything we're going to want to have for our first part of the template. Yeah, that's our cash flow problems there. So hopefully that was helpful. Now let's go. Let me snip. Bear with me for one moment. Okay, I've got the second template page for putting in the journal entries. And yeah, we've got all of our 1 through 6 journal entries here, six transactions noted. So let's work through these. Okay. The first one is this number 1 here. We purchased $700 of inventory from supplier company with terms of net 60. So if we're saying net 60, that indicates a payables type of situation. And so inventory is going to go up. That's an asset. And then payables will go up as well. So that's a credit increase for our payables. And that's looking pretty good. Okay, that's all we really need there. Then we sold on the 5th. We sold $1,000 of inventory, which cost us a certain amount of money. And so the first part to record the sale here, we're going to say AR, and it's $1,000. And then we're going to say sales revenue. Revenue, I spelled that wrong. 1,000. Okay. Now to record the cost of goods sold piece, we want to reduce our inventory and record the expense for getting rid of the inventories because it's now gone. So that's where we get cost of goods sold. And it's $750 for both of these ones. And this is inventory going down. An asset goes down. So that's a credit. And then an expense goes up with a debit. Excuse me. Okay. So we're good there. On the 12th, we performed $2,000 of services for a company on account, or a client on account, I should say. So I'm just going to copy this down, and then I'll change the date. AR is appropriate there because we're going to be paid later, so we're going to receive the cash later. And this was service revenue as opposed to sales revenue. Not a huge, biggest deal in the world if it's revenue is revenue, but just to classify that completely accurately would be more service related because it tells us services here. Okay, we purchased equipment by check. If we say check, that means we're going to have cash as an outflow. And equipment, so one asset, they're both assets. One goes up, the equipment asset. One goes down, cash asset goes down, right? Okay, pretty basic. 1122x9. We received 2,000. Now we received this amount from here. So remember, it was AR. Now this kind of ties in with our cash flow problem. Remember, when AR goes down now, it's going to be a increase in cash, but and a reduction in AR. So this is a good illustration of some of the problems that we looked at for the cash flow statement, where this is what would be in net income, but this is if we're trying to adjust. We have to look and see, okay, AR went down, and if we didn't get, one period we got the AR, and then the other period we collected it. Year 1, for example, it goes over the years, and the cash flow statement is prepared at the end of that year, then it wouldn't offset because we hadn't, we'd have to back this revenue out of net income on our cash flow statement because this is a non-cash transaction essentially. So anyway, that ties back into what we were looking at before, but it's relevant. So, okay, we received our electricity bill. So we'll just say electricity expense. You could say utilities expense or whatever. PG&E, okay, so our expense goes up, and we didn't pay it yet, so that's going to be a payable. Remember, when we have an increase in liabilities for payables, because that we're going to pay it in the future, right? So All right, hopefully those transactions make sense. This is pretty basic accounting, you know. Hopefully you can walk away from this class with some of that basic understanding of the debits and credits and assets. And, you know, this just speaks to all those general understanding that you should have about basic account types, how they're transacted with, what do they reflect, and all that kind of stuff. Okay, next we're going to hop over to our work problems 2 questions. And so here we're going to work on some adjusting entries, and then we're going to do some various bond and equity type of transactions from I think it was from maybe chapter 9, 10, just the more current chapters here closer to our final. So yeah, let's work on that now. Okay, so just like I did with the last problem set, I'm going to snip our information here because I have a template that we can work in, and we'll just do that directly there. Okay, and then each of these kind of match up with A, B, C, D, E. So this one doesn't have us put dates in, so that's fine. We're just going to go without the dates for these journal entries, no big deal. So here we're saying the trial balance shows 1,500 in supplies, but only 800 are left. So remember, we get to the end of a certain period, we might need to adjust our supplies balance because some of those supplies have been used up, and the accountants don't get told every time someone prints paper out or something, so they have to have some methodology for going and checking how much supplies are left. And at that point, which maybe happens at the end of the month or the year or the quarter or whatever, then we'd go and say, okay, so we had 1,500 to start, now I only see 800 left. So the difference there is 700, and we're going to record that one as supplies going down. It's an asset, so we're going to credit the asset there to reduce it, and then we're going to have supplies expense being the debit to reflect that those supplies, that much of supplies have been used up during this period. And then again, you've reduced your beginning balance that it showed on 1,500 down to 700, down to 800, which is accurate, and that will be on your adjusted trial balance. So this is basically saying the unadjusted trial balance showed 1,500, but in reality it needed to be 800 because that's all that was really there. So we had to do that adjusting entry here. Okay, we've got an unearned revenue type of transaction here. So we received $24,000 advance, so cash goes up by $24,000. Then we have the liability of unearned revenue, and that would be, that's our initial entry. What we need to do now is our adjusting entry, and to do the adjusting entry then, I guess let me do it over here where it's a little more. So if it's $24,000, and that was a prepayment by a customer reflecting 12 months of service, you'll put 12 months, cash prepayment received. That means that if we're they're gonna pay us every month for these, we're doing these services on a regular cycle of monthly. Every month we earn $2,000. Then, so just divide, the total year of 12 months there to get per month. And then we can go through and say, okay, if we receive this on 4/1 and we're doing our journal entry at the end of December, then we're going to be, the only months that we're excluding from this 12-month period then would be January, February, and March, right? So again, just to kind of break it down here so you can see what I'm talking about. So here's the whole 12 months of the year. We got the 24,000 at the very beginning of April. So that means April, we're assuming it was part of April. And so for every month we earned this much, but we didn't get paid we didn't start earning that revenue, and we didn't get the cash anyway on 4/1. So if you look at the total there, it's 18,000, and that's 9 months out of the year. So another way to do that is just to multiply 2,000 per month times 9. So basically what we're going to then do is reduce unearned revenue liability and record revenue for, and I guess we could specify service revenue because it says prepaid service. And yeah, there you go. So we've now we've reduced our unearned revenue down to only being 6,000, which is going to reflect another 3 months that will be in the next period. And we've recorded the earnings from that, those 9 months into the current period with our credit there. Okay, so rent being expired is so very similar. We paid $12,000 for rent in advance on 9/1, and so now we have to see, okay, on 12/31, how much expense do we need to record for this prepaid rent being used up? So very similar. I can show you in a formula. So this is our whole payment, or total prepayment. It's for 6 months. That means per month then we're incurring $2,000. That represents $2,000 of rent expense per month. And we're saying that we paid this on 9/1, and so we had September, October, November, December. So 4 months of rent of time, is passed between these time periods. So then we're going to increase our rent expense. So we can do our 2,000 times 4 months, so 8,000, and reduce prepaid rent down to 8,000 as well. And actually, I'm going to paste this in as values, so if I erase this formula, it doesn't go away. But that will be our entry there. Here we bought a machine, and so let's do our depreciation calculation. So it's $24,000 machine minus $5,000 salvage value means we get 19,000 of depreciable value, and then we're going to say it's a 7-year life, and that is equivalent to, because we're going to want months here, that is equivalent to 84 months. So then that means that depreciation per month then is 226, so 0.19, whatever. So we'll just round it to 226, and we'll say depreciation expense per month. And then we just need to look and say, okay, how many months do we need to record for it? So since we started this using the machine on 10/1, we're going to count the month of October as one of the months. So October, November, December is the time frame between 12/31 and 10/1, so 3 months. So we just need to multiply this number by 3. And then we're going to remember depreciation expense. It's an expense, so we have a debit to increase it. And then remember our special contra account of accumulated depreciation, contra asset. And we'll say equip or machine, I guess it's machine. And there you go. That's our credit, and it's our contra asset. Finally, warranty expense. We had 10 million in sales. And actually, again, I'm going to copy and paste this in so I can delete this stuff out. We can analyze the next problem. So here we had 10 million in sales. We had an estimated warranty of 2%. And so if we take 2% of 10 million, we get 200,000. And so then we just record warranty expense for that 200,000. And then we're going to say warranty liability to reflect that we now have on our books the expectation that we're going to have to pay out 200,000, but it doesn't happen all at once. Warranty claims can come in the future throughout the whole time period that they are allowable. If it's a 2-year warranty, then you could have a claim, at any point. Once it's past those 2 years, you can't get any more claims on it because the time period's gone. But this will reflect that we have that liability basically incurred now. So, all right. Well, hopefully that helps you all. Adjusting entries, important stuff to remember. And let's move on to the next part of the problem here. Okay, so number 5 says, here's some payroll information. Again, I'm just doing a little snip screenshot. And I've got to work. I think I have a, yeah, here we go. Okay, so we've got a spot to put some journal entries here. And we're going to record the employee salary journal entry, the payroll tax journal entry for the employer. A little typo there. And then we're going to record the final, one of the final parts of the entries where we're actually making that payment to the employees after we've already recorded the payable and the salaries and everything. Okay, so we are on, what is this? Okay, so it just says October, so we're just going to put 10-1. We're going to assume they pay once during the month, essentially. They're actually making the payment, it says, on November 5th here, but we want to make sure that we record all the expense into October because the employees earned those wages and the business incurred that salary expense in October. We are making the payment in November, but we want to make sure to put the expense in the right period, so that's what we're doing with this. All right, so I'm going to say salaries and wages expense. It tells us it was the employees earned $20,000, or the business, incurred $20,000 of wage expense. And then here's the breakdown. So FICA taxes are withheld $1,530. So remember that FICA taxes are paid both by the employee and by the employer. So we are going to see some FICA tax recorded down here. But the FICA tax we record down here is going to be a FICA tax expense with a taxes payable component as the overall outcome. This is the employee's payments. So really it's the employee's expense, but on our books, we just withhold those payments for them. So it becomes a liability because we have their money to send to the government later. Okay, we have federal income taxes, again, withheld from the employees' paychecks, that we need to do that. $4,000. It doesn't, now none of that is related to the employer. That's just us as the employer withholding it from the employees. Then we've got 401k contribution payable. So we withheld $2,000 from the employees' paychecks for their investments, their retirement accounts, and we need to remit those to the retirement account provider. Whoops. And then the difference then, we're down to the last part of the item, is salaries and wages payable. And you could maybe just put wages expense, wage payable, whatever you got, salary expense, salary payable, not a big deal. But make sure that you got your payable here reflecting how much you're actually going to pay to the employees on November 5th, basically. So we're going to give them cash of $12,470. They really are owed $20,000 of total wages, but we're only giving them this much, and we're going to take this money that is on their behalf, send this to the government, organizations later, basically. I'm going to jump down just to show you, here's the result. This was in October, and then when we actually make that payment on the 5th of November, we're going to reduce the liability, and we're going to reduce cash as we paid it out. But you'll see the expense went into October. The cash transaction happened in November. So that is all good. Okay, let's finish out the employer side. So the employer incurs some taxes they have to pay just for having employees, basically. And then there's unemployment taxes, FUTA, federal unemployment, and SUTA, state unemployment. And we're going to say tax expense. Now, again, these are expenses, so we need to fix our formatting here because they are going to be debits, and it was 50 and 375. And then we can just say payroll taxes payable, that the business just owes all this expense out to the government organizations, so $1,955. So memorize these types of journal entries. Very similar. I don't want to highlight memorization a ton, but there are a few things that you probably should know and have committed to memory. such as the fact that the businesses are the only ones paying the unemployment taxes, that the FICA taxes, Social Security, and Medicare are paid both by the employee and the employer. Federal income taxes and state income tax, any income taxes you see related to payroll are going to be payables on the employee side. And then 401k contributions could have a component that's employer-based, but only if the employer is also paying some portion. Otherwise, we're just withholding the employee's money and sending it to the retirement account provider. Okay, let's come down and take a look at our next section of problems here. Give me one moment. Again, I'm going to paste in a screenshot. Excuse me. Okay. And actually, there's some valuable information here, but let's just look real quick first at the problem here. So it says on 1/1 of the first year, your company issued $250,000 of 3% 6-year bonds at 97. The bonds pay interest semi-annually, so 2 times per year. Record the entries on the 1st and 6/30. The first interest payment would happen there June 30th. Okay, so here's some helpful information for this problem also. It tells us that, so here's a face value, and it's just there, 3%. So the issue price, when we say at 97, that means we're going to take 250,000 times 0.97 to basically indicate that the amount of cash that we're going to receive is going to be less because we're issuing it at a discount. So we're only going to receive $242,500 instead of the $250. And then we're going to say discount on bonds payable. And then we're going to have bonds payable. And the bonds payable are just at the actual amount because we're going to have to pay back the $250,000. So then we can just basically take the difference between those two to figure out that our discount was $7,500. And that's also sort of shown here in this box. And so it was 6 years, I think is what it said, right? Yeah, 6-year bonds and semi-annual interest. So therefore, there's going to be 12 payments throughout those 6 years, 2 payments per year. And so to amortize our discount, we divide our 7,500 by 12. I think I'm supposed to say 7,500. Let me make sure that's 625. Yeah, so that still makes sense. So then as we're making our payments, so for example, on 6/30, we're going to make a payment. Cash is going to go out. And the amount of cash that's going to go out is the total amount of interest on the 250. So 250,000 times, what was the rate? 3%. And then, but here's something to keep in mind is that we don't just want to multiply by 3%. We want to multiply 3% divided by 2 because we're making 2 payments during the year. So we get $3,750. And then we get interest expense is going to be the total amount of the interest, but we're also going to have an amortization of our discount on bonds payable. And so we're basically whittling it away to 0 over those 12 periods. So like we mentioned, it's 625, or this number divided by 12 total payments that are going to be made 2 times per year. And so then our interest expense just becomes the actual interest we owe plus the amount of the amortized bond payable to get $4,375. Okay, let's take a look at B. So it says on 1/1, same time there. And I'm going to copy this in just to have it, and we're going to modify it a little bit because now we don't have a discount, but we have a premium on bond payable. And so we can see some additional info here as well, is that 102 times, so it's issued at 102, it says, which means we take 80,000 times 1.02 is 81,600. So the premium then is 1,600. We could take this times 0.02, 1,600. And that means that the amount of cash we receive then is higher than the bond amount, so we get 81,000. That's one thing to keep in mind. If it's a discount, the cash you get is less than the bond. The face value, if it's a premium, you get more cash than the face value. All right, so that's great. So now we want to record the entries. That was our first entry. And then I'm going to, again, copy this in, use it as a starting spot, change this to premium on bonds payable. And now it's going to be a debit, right? We're whittling this down. It was a credit to start, so we whittle it down with debits. And we just need to know how many times it's going to be paid. So it's a 2-year bond semi-annually. So 4 payments are going to happen. So we're going to get $400 per period. The amount of cash that we're going to pay is the 80,000 times the interest rate, 0.06, divided by 2, because it's 2 payments per year. So I get 2,400. You can kind of see that here, cash payment per period. And then our interest expense will be lower than it would be otherwise because we have the premium. So we take the 2,400 minus the 400 amortization to make our interest expense 2,000. Okay. All right, let's look at our next entry here. Oh, I just realized that this is missing C, ABC. So let me, sorry, bear with me for one moment. Let me fix this real quick. ABC, C, D, E, F, G. Let me re-snip this. Okay. So now we're on C, and C says your company issued 2,000 shares of $2 value par common stock and receives 50,000. So it doesn't really give us a date in these, so I'm just going to bypass that and just go into the entry. So we got cash. It tells us we received $50,000, and we're doing common stock here. Remember that the common stock is always just the par value times the number of shares. So it was $2 par value times 2,000 shares, so 4,000. And then the paid in additional paid in capital, we'll say common, will just be the difference between the actual cash we received and the par value of the stock there. The next problem on E's has something real similar. Oh, geez. And then this, sorry. These numbers are all messed up. Okay, that needs to be E. Wait, what am I missing here? That was. Make sure these all match up. That was A, B. Here we are with C. D, we'll talk about our preferred stock here. So, okay, D, and then this should be E, F, and then I think we do this and fix this here. Okay, sorry, thanks for bearing with me there. Okay, D says your company issues 5,000 shares of $1 par value stock, so $1 times 5,000 shares. And it says we received, it's $10 per share, so $10 times 5,000 shares. Okay, still 50,000, just like it was above. And then, but we just, again, take the difference. So 45,000 now, and the only real difference between these two being the $1 par value instead of $2 par value. Wait, did I see that right? I mean, yeah, $2 par value here with only 2,000 shares of stock. So the result is the same. There's, 2,000 shares of stock here, 5,000 here. And the only thing we really need to make sure to be careful of is this is preferred stock. So update the titles here to represent preferred. Okay, and now on E, it says that we buy back 1,000 of our own shares. So that's where treasury stock comes into play and cash. And remember, when we're buying 1,000 shares at $50 per share. So that would be 50,000. Remember, with treasury stock, we don't need to worry about the additional paid in capital, etc. just treasury stock and cash. How much do we pay? Okay, F says we declared a dividend of oh, you know what? Actually, as I'm just looking at this one as well, sorry, I apologize for doing a little cleanup on this, but this is the same problem essentially. I just realized later when I was looking at this, so I'm going to fix that. You shouldn't have to have that problem here. In my final snip, really we just need the F last. Whoop, oh, that's not the right spot. Where's our... There we go. Okay, so we're just down on F. So in this, we've got a declared dividend, and I will put the dates here because they're kind of important in this one. So 10/31, we declared a dividend of $1 per share, a record date of 11/30, and payment date of 12/31. 5 million shares authorized, 200,000 issued, and 150,000 outstanding. And so remember, we go to outstanding when we're doing our dividends payable entries, and retained earnings will be the debit. The payable is kind of, that hopefully is relatively straightforward. It's $1 per share, so it's just 150,000. If it was $2 per share, it would be 2 times 150,000, 300,000, so on and so forth. And then our debit there takes that out of retained earnings. Think about the retained earnings statement. That's one place you see kind of a similar deal with retained earnings being reduced by dividends. So it might be helpful to think of that. Hint, it says all dates might not need a journal entry, and the clue on that is talking about the record date, because the record date is just us when we go to the records and see who needs a payment at that point in time, but there's no journal entry needed there. But there is a journal entry on 12/31 when we actually make the payment. Then we basically just offset our payable, so it goes to 0. We decrease our payable by the 150,000, and when we're paying a dividend, cash is going down, cash is going out of the business, so credit cash for that same amount essentially. All right, well, that brings us to the bottom of all those problems there, and the last problem that we're gonna look at here is one that really is it's a balance sheet or a financial statement problem here. So I've essentially just got this all in. There's no separate question tab for this one. It's all just basically within here, and you've got the trial balance you need to prepare the problem here, and then we're going to just fill out all of the information here for the accurate placement. So let's do that now. Okay, so as I mentioned, we've got all of our accounts listed here in our trial balance. We're going to start with the income statement. So we're going to want, I'm going to set this whole thing up, and then we'll link in our totals. I'm going to use a VLOOKUP, and if you all want to use that, follow along. That's a good tool to practice with. So sales returns and allowance. Remember, that gets us net sales. Then we've got cost of goods sold to get us to gross profit. Then we've got all these operating expenses. Here they start with bad debts expense, and we've got enough space here that if we just drag this down, it goes all the way to warranty expense. So everything here is an operating expense, and then these other categories are going to go down in the other section that we will do right now. So then we'll just pick up starting there with gains and losses down to interest revenue, and then the only thing left is tax expense, and we've kind of got our whole income statement filled out. So again, I think I showed this in a homework problem, but using this VLOOKUP formula, we're going to say to Excel, look at this identifier, the lookup value, and then here's this table that goes over all 3 of these columns, and it says look in the first column here, so this whole row of the name, and return either this or this based on whether we put 2 or 3. It depends on whether we want a debit or a credit. The first one is sales, So you have to finish that out. So row 3 means we're going to pick from credit, which is appropriate. False just is, you got to put that in something Excel part of the formula. Don't worry too much about that. But then the one thing we have to keep in mind here is if we want to pick up something that's in the debit column, we need to put 2 because now we're pulling from the second column over. The first column being the one that has the identifier in it. And if we're going to use that formula and we're going to have, if we ever need negatives like we do kind of here when we have pluses and minuses in the same section, we're going to need to put a minus sign in front of the formula. This will be subtractive, but we don't need a minus sign. So we're just going to paste that in, but yeah, take off the minus sign there. Net sales minus cost of goods sold. We get 700,000. And yeah, let's keep rolling. Okay, so everything that's an expense is in column 2. So I'm going to just highlight all the cells. I've copied this VLOOKUP formula, just Control V to paste. You can see it just populates instantly, which is the real value of VLOOKUPs are pretty powerful. Now, anything that's a negative, a debit or a reduction here, we're going to use the one that's pulling from column 2. And then we have gain on sale, rent revenue, and interest revenue. And we're going to want to pull from column 3 there. So I'm going to copy that formula. Now, one thing to watch out for, though, again, when they're in the same, really we should just use this formula because it already has the negative. And total other becomes 20. And then we just need to add all of our totals together. Oh, rent expense here. Let's not forget, or sorry, tax expense. And pre-tax net income then is gross profit minus operating expenses plus, in this instance, we've got a positive net other, and then subtract tax expense, and we arrive at $43 of net income for the period. Okay. Now we've got net income. We're down to the retained earnings statement. And so, a couple of things. Let's use our VLOOKUP formula to pull in our retained earnings beginning balance. And then our net income, we just link from above. So we don't do a VLOOKUP there, but we need to calculate that amount. And then we have dividends. So let's link there. Dividends are from column 2. But they are a negative, so let's make sure we put our minus sign there. So 345. Okay, let's go fill out our table. Let's do the accounts first, and then again we'll pull in with VLOOKUP balances. So all of our current assets are up here at the top. It's everything from cash down to supplies, essentially. Then our long-term investments, we have land held for speculation and notes receivable. And for plant assets, we have, starting with building, we have some accumulated depreciation we need to make sure we include in there. And then we've got some, starting with goodwill for our intangible assets. Okay, so that's all there. Let's go ahead and do our VLOOKUPs now. So if we're pulling in something in the column 2, which is what all the assets have, we're going to want to choose from one of these formulas that's pulling column 2, like for the expenses. Paste that in, drag it down. And the reason why we can drag this one so easily is because I highlighted all the columns, so it really doesn't matter if you move this formula around. That makes it really easy for a VLOOKUP to not get messed up by just picking just the table. If you do the whole column, then it's always going to be selected, even if you drag it around. Okay, so current assets 410, but there's one little thing to watch out for. We got our 0 here, right? And so that's going to be in column 3 because it's the contra asset, and make sure to make it negative as well. So don't watch out for that if you're ever doing VLOOKUPs here. Again, on the test, you're going to be doing this via paper, but this is a good trick to know. Oh, again, we got a contra asset account, and sorry, not accumulated depreciation. I think I said that. Allowance for doubtful accounts up there. this is where the accumulated depreciation shows up. So we've got 600, and then paste in my VLOOKUP for all of those intangible assets. Then we just add all our asset categories together to get 1385. So that's looking good. Okay, now let's finish this out by looking at our current liabilities. And we're starting there. AP is kind of always our starting point. So now you see it pulls in bond payable. So one thing you got to be careful if you're using formulas and everything is that not always will it be exactly in a row, necessarily, because bonds payable is going to be a long-term liability, but dividends payable typically is within 12 months, will be more of that normal category of such. And then that's all of our current liabilities. And as I just mentioned, bonds payable is one of the, we've got bonds payable, discount on bonds payable, and then note payable. And yeah, let's go ahead and put our balances in. Whoops, that was not what I wanted to do. Let's get our VLOOKUP formula. Okay, and we need to pull from column 3 for liabilities because they're credits. No contra accounts or anything, so we just use that formula all the way through. But there is a contra account here, so that is a contra liability, so it's going to be in the debit column. Let's make that negative, how we want it to calculate through. And then that's our totals. So we add our current and our long-term to get 795. And we're almost done now. Let's go to our equity section, starting with common stock here. Now, one thing to be careful of is the account that we see here is the beginning balance of retained earnings, but we don't want that one at 1/1. We want ending retained earnings, which is what we calculated above. So that's going to come down from here, not from the trial balance. And then, but in all other respects, we're going to have, whoops, got to put the pull from column 3. Credit balances for these equity accounts, except for treasury stock, because that is a contra equity. And remember to make that one negative. Gotta watch out for those contra accounts. So then we get 590. We add our liabilities and equity together, 1385. And then just to do a check figure, you can kind of eyeball it, but you can see here that total liabilities and equity, adding those together equals our total assets. That means we're in balance, and the accounting equation works, and we're happy, and everything's working good. So that gets us through the study guide work problems, essentially. So hopefully y'all are picking up on everything pretty well. Let me know if you have any questions. We practice in class a little bit, but this is, I would recommend watching the video if you need as much help as you need, and then try to solve these on your own. And if you can solve these on your own and get the right answer, you should be really well prepared for the exam. With, the addition of going through your notes and other resources and honing in on these topics and making sure that you understand kind of the key components here. Again, some of which are things that we've, looked at throughout the whole semester, not just the recent chapters, essentially. But those things being relatively basic and not tested heavily from a work problem perspective. What you'll see on the exam will be very similar to what the work problems are here. So hopefully no big surprises. All right. Well, thanks everyone. Good luck studying and good luck on the final. And I will see y'all soon. All right. Thanks. Bye.